Manish, are markets completely hostage to what's happening on the medical front? Because when there is an unfortunate spike, or when there was an unfortunate spike in Maharashtra and Mumbai, markets start tumbling down. When there is a sign of the medical numbers peaking in Mumbai and Maharashtra, markets have started rallying. So do you think in the short term, next couple of months, it's all about the way how the corona numbers would move?
Yeah, that obviously is having a big effect, although I must say that markets have probably been more resilient than many of us thought, given the scale of human tragedy around us. So you're correct. Basically, medical numbers will have an effect, but I think people are also deriving a lot of comfort from what's happened on the virus front globally, because clearly we've seen Israel, US, UK, which have vaccinated a lot of the population, see a fall in cases and deaths. And therefore, I think as of now, the market is assuming that this is a passing phase. In 1 or 2 months, we will be behind this as the vaccination penetration goes up. And I think market's taking a fairly optimistic view that this is not going to derail the economic recovery, which is our baseline case as well. Good part is global growth is very strong. So see, about 30-40% of our earnings are actually not related to India itself. And if global growth is strong, that part of earnings is obviously safe. So what I think the virus is a bit of a tail risk now, in the sense that more than the virus, it's side effects, which could be a hit to the consumer psyche, which could be a change in government expenditure towards populism. All these tail risks, if they materialize because of the virus, I think that's going to have a bigger impact. If global experience is correct, if whatever we believe on medical side is correct, I think touch wood, we should see cases and deaths taper off soon.
Is it too early to assume that banks will emerge clean, at least retail-dominated franchise in the second wave? Because in the first wave, fear was more, corporates got damaged, and the number of casualty, at least on the retail front, was not there. Currently, corporates will emerge strong because they have their processes and learnings of the first experience. Some corporates have adopted work at home also, at least the big manpower-dominated industries. But the entire casualty number, number is going to be so large that it will have an impact on demand. It will have an impact on productivity levels. It will also have an impact on the repayment capability. So do you think banks, especially retail-focused banks and NBFCs, they need to be avoided?
Not really. I think because there is multiple forces out here. So if you look through the virus, there is obviously a big consolidation through technology or regulation kind of play in a lot of sectors, including banking. So I think the good part of the market is, by definition, the higher weights are with the large private banks, and they are, as of now, structural market share gainers. So it's not that if credit growth grows at 6 to 10%, it's not that a lot of these big private banks will see a big earnings downgrade, because since they're growing faster in the system, 15-18% growth seems to be quite possible for them, because the PSU banks are not growing, the smaller banks are growing slower, the weaker NBFCs are kind of going out of the system. So I don't think you should see banking purely as a beta play, saying that if the economy goes through a slightly soft patch, yes, if the economy goes through a disastrous patch, no banks work as a stock. But if, as long as we are within a reasonable range of economic growth, and this time, as I said, unlike last year where it was a global crisis, since global growth is going to be fine, it will have some tailwinds for India growth as well, even if the domestic scene on the virus is a bit concerning. So we are kind of, when we look at financials, the large private banks, we're kind of looking through the virus and saying these are good structural stories to own on a 3-5 year basis.
Manish, my sincere compliments. I remember we used to have a chat that, okay, how come you're buying Tata Group of companies? And, we've discussed, while you've always made a case that it's a coincidence that you bought those businesses which had Tata name associated with them, but all Tata Group companies now have emerged as clear winners. Do you think Tata Group of companies, given the kind of capital allocation call Chandra has taken, still have a long, long way to go? Because with the exception of one or two Tata names, which are driven because of external factors and COVID factors, most of the Tata Group of stocks have regained their lost glory.
No, definitely on an aggregate basis, you're seeing a big momentum in that too about going for aggressive growth on the consumer staple side. They've created by merging and doing internal changes. They obviously created a good growth engine. So overall, the group's aggressiveness for growth, the group's capital allocation, everything seems to be trending quite well. And as reasonably significant shareholders in a lot of the companies, we obviously have liked that a lot. So we think that that's going to continue. I think the group has focused on certain select key verticals for next from a long-term perspective. And I think that's always good because the capital allocation is obviously strong. So overall, yeah, it's been a good experience.
Indeed. Manish, a little early to analyze, but just wanted to understand what's been your takeaway from what we've heard on the India Inc. Q4 scorecard as of now. It's turned out to be a bit of a mixed bag for financials. The private lot has done, of course, a lot better, has managed to beat the estimates. IT has delivered at par. And some disappointments beginning to trickle in when it comes to FMCG. Not completely unforeseen, but we did anticipate that, RMC costs are going to be a big factor and they're going to weigh heavy on the margins.
You're correct. I think when you look at Q4 earnings, and I think also going forward, I guess, again, this is a bit of a global trend that you're seeing a kind of K-shaped recovery, right? That the top 10, 20% of households in any country, they're obviously recovering much, much better than the lower half because a lot of them have salaried or fixed income, which obviously has been accruing over the last 14 months or so without having too much expenditure. So the balance sheet is good. The markets have done well, so their savings in terms of assets have done well. So when you're looking at sectors, I guess, and we were discussing banking earlier, I think lenders focused on the lower half or any business which is catering to the rural population right now seems to be probably facing more headwinds than, let's say, any business which is catering to the top 10, 20%, as long as it's not hit by outdoor consumption. So obviously, retailing or multiplexes or hotels have taken a hit, but otherwise, the premium FMCG products, anything which is digital, catering to the top 10, 20% is doing really well. And I think when you look at results, see, one is the global growth related sector like IT and all seem to have done pretty well, although maybe the expectations were higher, the multiples are higher. So people did not get very excited about IT results, but the cash flow is good. They're growing low double digits, which is obviously being more than what they were growing earlier. So whatever is related to global growth obviously is doing well. Your metal, steel, everything's doing well. Domestic, as I said, first of all, Q4 itself, limited perspective because the virus issue really accelerated in April. And so it's more about going forward. And I think the challenges will either remain on the raw material side for a lot of consumer facing business, but I think that's a lower challenge because that's a kind of one-time thing. So you don't expect commodities to compound. So maybe there'll be one price hike somewhere down the year and that will get handled. But I think the bigger challenge is whether the lower half of the households When does growth come back? When does rural India come back? That is not obviously very clear at this point of time.
Sure. Manish, wanted to also understand where is it that you stand on commodities, and I'm going to pick up metals over here. Is the good going to get better from here, and is the better somewhat in the price already, or do you think these stocks are still far away from their long-term averages?
So it's very interesting that when you look at steel, the prices are almost at all-time high, and usually being contrarian in metal work, so you should say that the stock should have peaked out. But this time you're more positive, purely because given where the prices are, one is that the stocks market caps or multiples are lower. So your free cash flow yield, your EV to EBITDA is quite low. It's quite attractive. The point is, do we expect commodity prices to go from here? Very, very unlikely. I mean, so there is the other part is that the China plus one thing that China obviously cutting down on production of a lot of pollution causing kind of goods. But really, it will be unfair to say that we are positive on commodity prices. But I think there is a bit of last 20-30% upside in a lot of these commodity stocks, which is based on the fact that even if prices remain or fall 5%, you have buffer in terms of your free cash flow yield or EV to EBITDA multiples, that even on those lower prices, the stocks are quite cheap. And then you have the added overlay that if globally economies are recovering and bond yields are going up, then short duration cash flows are obviously valued more than long duration cash flows, which is why maybe the tech stocks will underperform versus value stocks. Given all that, we're still positive on commodity stocks. Major return obviously has been made, but we do think that 20-30% kind of upside is quite possible just by the prices remaining where they are at this point of time.
Manish, what are the trends that you're picking up when it comes to the pharma universe, and what's looking interesting to you there?
Pharma, I think, obviously did very well last year. So in general, we don't find the stocks at distress level. I mean, we don't think that there is huge upside on the sector as an aggregate. But obviously, you have some stocks which are product oriented, which have certain molecules, certain vaccines in development, etc. But overall, we think more or less fairly valued. If at all we see upside in some of the hybrid names, which are mix of domestic growth and US facing business, where the US facing business has gone through 3-5 years of fairly tough period. So those are the kind of names we see some upside, but broadly not very excited about that space.
Okay, and on discretionary or even otherwise, when it comes to consumption, and given the fact that we're starting to see input cost pressures build up, and the double whammy of both input costs as well as what we're seeing on the demand side, given the current situation, is that an area you'd stay away from? I see that it's not on your preferred list in any case, but would you also steer clear altogether?
Let me nuance it a bit. I think the biggest part of discretionary in India is auto, and auto has not only some short-term headwinds in terms of either raw material costs or this virus issue. We're obviously seeing globally autos get disrupted with electric vehicles, and both two-wheelers and four-wheelers now fall in that category. There's been a lot of development on the two-wheeler side, on the electric side. So there is a host of auto stocks where the growth beyond 5-10 years looks very questionable. So that's the big issue for us, that Yeah, a lot of these near-term headwinds can be temporary, but there are also long-term issues. The other part of discretionary, which is reasonably big, is retailing. That also has some online kind of competition which is coming up, but I think a big part of retailing will still be offline even in the long term. So we're more positive a bit on the retailing side, although there also the valuation is not very cheap. So 25, 30 EV to EBITDA kind of valuation. But relatively, I think from a long-term perspective, the fact that hopefully if this virus issue dies out, a lot of pent-up demand in the urban consumption area is likely to manifest itself. So we're more positive on retailing, maybe multiplexes as a contrarian bet, rather than discretionary as the entire basket, because as I said, autos is a bit of a tricky area for us.
Manish, who will be the winner of this so-called commodity uptick? Because right now, commodity companies or producers are making money, consumers are losing. When do you think the tilt will happen back in favor of consumers?
See, Nikhil, I don't see it too much as a zero-sum game for Indians specifically, because even when you're looking at commodities, the biggest commodity by value is oil. And when, I think globally, not too many people are excited about oil because oil has a lot of renewable technology as a competition coming. Electric vehicles again will take away from oil demand. So I think where the more structural upside in commodities is metals that are going into electric vehicles like copper, etc., which India is not really a big user in terms of percentage of GDP kind of metric. If you use, we're not going to get hurt by copper or aluminium too much. The other big part is steel. Now, steel, as I said, we don't think prices should go up from here. It's kind of either a cyclical upside which has played out, or if China remains to its target of pollution and rationalizing manufacturing, we could say that prices will settle 5-10% lower than here maybe. Because there's enough money you can make, any steel producer can make a lot of money at this price. So we do think that supply will come back, production will come back eventually in steel. So I don't see too much of a country losing out because of this, because I don't think oil is going anywhere. So if oil remains around 50, 60, I think we should be fine.
Well, it's turning out to be a very good day if you are an individual stock picker. I mean, the market breadth has been doing phenomenally well. Manish, are you making space for the new businesses, Nazara or Zomato, which is planning to go public? Policy Bazaar goes public later this year. Are you making like significant space for them?
Well, Nikhil, I have to admit that's going to be a big challenge for us as an investment house. We obviously have exposure to the smaller names which have IPO'd recently. A lot of them have done well for us. But yeah, I mean, the big ones are obviously going to come in the future. Now, given that a lot of them are private equity driven, they will obviously not come at distressed valuation. And market is also quite healthy. So, and these are not the traditional price to earning kind of stocks, because these are obviously high growth companies which may or may not be profit making as well. But I think we'll have to obviously look at them from a market cap perspective versus the growth opportunity available to them. We're very excited about some of these. I think some of them are not just in the air kind of business model. Some of them are going to dominate the industries they're present in. Obviously, valuation we'll have to figure out. But I think it's very exciting for the market. It's very positive for the market that we get some high growth, high quality, great management. It's always very nice to see some of them come into the market. And I think it's be very interesting for everyone.
Manish, just to get a sense of how the flows have moved, and last couple of days, and I mean that's like last 2.5 weeks now, DIs are back. They're shopping again. Is this more like a cash which they were sitting on, they're putting to work, or now on the redemption side things have genuinely changed?
No, definitely we've seen foreign redemptions and gross inflows pick up. I think the numbers have turned for the positive last month. And I think I always felt that the domestic investors would come in after a 5-10% correction, which seems to be playing out. So I do think that the outflows we saw for about 6-7 months was just a blip in a bit of a structural trend, because clearly alternative investments like bank, FD, etc. are not yielding anything much post-tax. So I do expect that there'll be a certain amount of money invested into Indian equities consistently. Obviously, equities over the long term has delivered, not only in terms of returns, but also in terms of convenience, liquidity, etc. So I do expect that domestic flows should do much better than the last 6-7 months.
All right, Manish, really appreciate your time. So glad you could join us. Markets, meanwhile, they're holding on very, very smartly.